Home prices are crashing up. They are not going down. They're on an upward trend in many cities across the nation. So what does that mean for us? What does that mean for our future? And that's what we're going to talk about today. Hey there, and welcome to Brick by Brick Wealth. My name is Casey, and I help new real estate investors every single day find success with their first rental property. We've got a problem in America, and it happens to be with housing prices. Now, since most of my viewers are real estate investors, if you guys stick around to the end, I'm going to give you the top 3 long-term rental property markets that are crushing it right now with cash flow and appreciation. All right, let me get my iced tea, and let's get into it. First of all, we need to talk about why home prices are actually going up instead of going down. The answer to this is simple. It's because of supply and demand, but we're going to dig in a little deeper to help you understand. Do you remember the pandemic we had just a few years ago? Well, the feds really ruined the housing market for us because now people have 3% interest rates. If you have a 3%, 4%, 5%, 6% interest rate, are you going to now move up into a different home for a 7 to 8% interest rate? No, you're not. That is one major factor that's causing a huge housing shortage. Here's a little example. Blake and I have lived in Memphis since 2013. It is 2024 now. We've had some appreciation. We live in Tennessee on the left side, on the west side, so it's not crazy high, but our home value has more than doubled. We have 3 kids, we've been here 10 years, and we love an upgrade. We'd love to move up into something bigger, nicer, and better. But for us to do that, our housing price is going to go up 7-fold. I kid you not, in order for us to get to the next level of house, it's going to cost us almost 7 times our mortgage payment currently. So I have to think, is that worth it? Historically, people would need one life event to make a major move. For example, you get a new job, you make more money, maybe now you buy a bigger house. Or you have a baby, now you need a bigger, more room, so you buy a new house. Or maybe you get married and you're moving from that bachelor pad into a nice single family in the suburbs. Each one of those is one life event change. Well, with today's high interest rates and continually rising housing prices, it just doesn't really make sense to take on that larger mortgage payment just because you had a baby, just because you got married. So instead of the historical one life event people would need in order to make that move up change and sell their home and buy into a bigger, more expensive home, people are needing now on average 2 to 3 life events. So now it's like, well, I got a new job and I got married and I had a baby. I guess we really do need to make that move and buy a new home. So with all these people still staying in their homes with their 3 to 5% mortgages, not wanting to move, it's creating a huge housing shortage. The move-up buyer, in my opinion, is dead. Until interest rates severely come down, there's no incentive for a homeowner to move up and take on that larger mortgage payment for maybe a slightly bigger home. A lot of people are wondering, why isn't the market crashing? How come prices are going up when they should be going down? This time it's different. And I know you probably heard this a lot, but I was around in 2008 during the last market crash. And this is nothing like what we saw in 2008. In 2008, we had subprime lending. A dog could pretty much get a loan. You could do stated income. Here's another great example for you. Right prior to the market crash in 2008, I think this was maybe 2006, 2007, I don't quite remember, but I was a cocktail waitress at a bar. Me and my dad were gonna flip a house. I don't remember how much I made, but it definitely wasn't enough to really qualify comfortably for a home on a conventional mortgage. They had a program back there called stated income. With stated income, I would just state my income, and that would be all that they needed to verify me for a loan. They were going to give me over a $749,000 loan. I feel like that was the price at the time when I was a cocktail waitress. We didn't end up going through on that property. The roof had some issues we found during the inspection period, and we backed out. But needless to say, that type of lending does not exist today. Because of subprime lending and that massive market crash that happened and all the foreclosures and everyone lost their butts and the lenders got in trouble, new lending guidelines and rules came about. They've tightened up lending. So now you have to put 20% down or 25% down for an investment property. Now you have to be super qualified for that 3 to 5% down loan from Fannie and Freddie. Now lenders want the buyer, the borrower, to have some skin in the game. What skin in the game is referring to is actual cash invested into the deal. So if you were to put 20% down on a house, Do you think that would be easy for you to just walk away from foreclose, short sale? No. And that's the problem with today. Everybody has a lot of equity in their homes because of the subprime lending that happened in 2008, because of the tighter restrictions that lenders and banks have put on borrowers. Now, most of the borrowers who own properties have significant amount of equity built up in their home. Think about this. If you have $200,000 or $300,000 of equity in your home, are you going to easily foreclose, walk away from your property because life gets tough, because you lose your job or whatever? No, you're not. What are you going to do? You're going to say, hey friend, hey mom, hey dad, hey cousin, hey aunt, I'm in a bit of a bind. I lost my job or whatever, but I don't want to lose my house. Can you come live with me? Can you come help me pay rent? I foresee things like that happening if, quote, shit hits the fan and people are losing their jobs. People are going to do whatever they can to save their home because they have so much equity built up in their home. Not just from their down payment, but the time that they've had ownership. The reason why keeping your home is so important to many people is because that's where most people hold their savings. They'll have savings in a bank. They may invest in their 401k. But where is the majority of their net worth? It's usually in people's homes, in their equity. So they're not just gonna foreclose and get rid of it. The reason why nobody cared back in 2008 was because they didn't have any equity in their homes. They didn't even have a down payment in their homes. They were doing no down payments, really low down payments. And then when prices dropped, not only did your home price plummet and the value is gone, but you also don't have any money invested in it. So what do? You go, screw it. I'm going to foreclose and I'm going to wait the 7 to 10 years for my credit to rebuild. Another reason why people are going to hold on to their equity for so long and they're not going to foreclose and they're not going to sell their home and move up into a higher priced property with a higher interest rate is because a lot of people also live paycheck to paycheck. And since, like I said, that's where the majority of people's net worth is, they're going to do everything in their power they can to preserve that. So the equity that we all have in our houses is one of the major reasons why there's no foreclosures happening right now. Our equity in our homes as homeowners is important. Another reason why home prices are going up, and I'm going to be talking directly to my investors here, is because investment properties still cash flow, and those will always be in demand. So we might have seen a small price drops in some areas in homes above the median, which are not investment homes. These are homes that people would move up into, homeowners would move up into, and we already talked about why they're not doing that, which is causing a housing shortage, which is causing supply issues, which is causing demand to go through, right? Small supply, high demand means prices go up. But what about below the median? What about the investment properties? Well, those homes are also going up, and they will always go up, always, no matter what's happening in the economy, because those homes will always cash flow. Properties now that are under $200,000 in purchase price have a chance of cash flowing. And I know this through my extensive research. I coach hundreds of people on how to buy long-term rentals across the country. I'm familiar with ridiculous amounts of market, and I have a lot of market knowledge for the investment, the long-term rental property investment market. So I can say with confidence that there is no markets under $200,000 that are having trouble finding buyers. We are in multiple offer situations, over asking. It's just crazy out there right now, even with interest rates for investors currently being at 7.625, and even all the way up till 9 or 10% with the DSCR loan. So what really sucks with the sub 200K, which is the under $200,000 price point for homes, is that it is squeezing out the new first-time home buyer. And before you harp on real estate investors, let's just flip the switch and get an idea for why they're getting squeezed out. Let's say you're selling your home. It's in the under $200,000 market. Let's say your home is $100,000 and you're going to take the plunge and you're going to move up to that nicer, better home. And you don't care about the interest rates. You're going to do it, right? You've had your 2 or 3 life event changes and you're like, it's time. So you have your $100,000 home and you're going to be the move up buyer. Now you're going to sell your home. Right? Time is of the essence. It's springtime. It's summertime. You want to get the most money for your property. And you've got 10 offers on the table. They all came in one weekend. Let's say out of those offers, you have an FHA buyer, right? Someone that's doing 3% down. Their debt to income is really high. And you know that with FHA loans, there's going to be a lot of red tape and extra inspections. You can't have any torn screens or cracked glass. And you're like, oh, shoot, with this FHA buyer, if I accept their offer, I really have to fix up my house extra to make sure it passes all those inspections and requirements. Then you get another offer. It's at 20% down. Maybe it's an owner-occupied person looking to make their first home, or maybe it's another investor doing 20% down. Then you have another offer on the table, and it's an all-cash offer. The all-cash offer says, well, Mr. Seller, I'm going to offer you all cash, and we are going to close in 7 to 10 days, and I'm not going to do any inspections. You don't have to fix a thing. Now, which one would you pick if you're the seller? Would you pick the FHA buyer who is going to have a lot of red tape? Maybe their job is iffy, they're running a lot of the debt to income ratio, their financing might fall through, and if it does, you have to start all over again with the new buyers, new showings, and all of that, and it starts to clock. And maybe now you're running into fall when home prices and home buyers are slowing down, and you might be worried you might not get any more offers at that price. So you're like, maybe no, I'm not going to go FHA buyer. Next two offers you look at are going to be the conventional offer at the 20 to 25% down. They either can be an investor or they can be an owner-occupied person. And then you see your all-cash offer. Which one of those three offers, if you're the seller, would you pick? Likely you're going to pick the all-cash offer. Now, some people may choose the middle offer, and some strategies for that, which I can do another video, but a really good one is to write a buyer letter. If you are going to live in the property, you write a letter explaining who you are, because not everybody chases dollars. If the offer prices aren't too far apart, the seller might pick the owner-occupied. They might not want their home to turn into an investment property, and I've seen that a lot too. But if you have an FHA buyer 3% down and you've got an owner-occupied 20% down and then some all-cash offers, there's a ranking order of the offers and how they get accepted. And we all know which one the seller is going to pick. So now we have high competition in the lower price market, the market below the median, because we have investors in this market as well as home buyers. And then we also have housing prices going up in the above the median market, regardless of the interest rate, because there just aren't a lot of properties for sale, because no one in the higher price point wants to sell their home to double or triple their mortgage payment to get an equal quality house. So now we know why home prices are going up and why they'll likely continue to go up. And even if we get interest rates that drop, what do you think is going to happen then? We're screwed. Now we're going to have multiple offers in all categories because we have everybody that's been waiting for a year or two, or even before the pandemic. People who were worried about the economy and they weren't buying. Okay, then it turned into interest rates and they weren't buying. So we have a massive pent-up demand of people that are like, please, can I move? So if they don't feel comfortable with the interest rates and that's the only thing left holding them back, once interest rates go down, we're going to see housing affordability, I believe, at the highest we've ever seen. Some people are saying, well, just build more houses. Okay, remember back in 2008 with the market crash, what was happening before 2008? We had builders building, and I remember because I was in SoCal at the time, and around 2005, 6, 7, I would go look at all the open houses, all the new builds. Southern California was getting built out like crazy. Well, once we had the market crash, a lot of those areas were ghost towns. Builders couldn't pay to get rid of their homes, and a lot of them stayed vacant for a very long time. So now builders are cautious. Many of them went out of business, and it hasn't been that long. And builders today remember what happened to their parents or them or their colleagues, and they are not going to be put in that situation again. So builders today are cautious of overbuilding and oversupply. And when they do build, they have to build for profit. So do you think that builders are going to build a nice little small, affordable, single-story family home on a 1/4 acre lot? No, because that's not going to make them the most money. What makes money for builders is the improvements, the properties they build. So they're going to put some massive 2 or 3 story, large interior footprint property with 0 lot line and no yard, and they're going to charge $1 million plus for it instead of something that's smaller and has a backyard and a front yard. So even when builders are building, they're not building affordable properties anymore. They're building expensive homes. Either that or they're building multifamily for apartments. So what does this mean for us? If housing prices continue to crash up, what does this mean for our future? Well, think about it. This kills the American dream. The American dream a long time ago was to get a job, work there for 30 to 40 years, own your own home, and retire with your family. The American dream of owning your home, in my opinion, is going down the toilet. I worry that our kids, my 3 kids, won't be able to own homes in their lifetime, especially with the trajectory that this economy and this government has taken. Unaffordability is going to be through the roof. We'll have multiple families living in one house just to survive because people aren't going to be able to afford these $2 million plus properties. Jobs and wages just aren't keeping up with housing prices. We may start seeing more and more ADUs being built on one lot. ADUs are the little extra homes that you see on people's lots. You may have someone living in the main house, grandma and grandpa living in another house, and maybe a sister or brother and their family living in another house. Unfortunately, we're also going to start seeing higher rents. As home prices increase, so do all of the expenses that come with it. Those expenses, unfortunately, get passed down to the tenants. Those expenses are going to be higher property taxes because the housing prices are going to be higher, and home insurance. Not to mention, as time goes by, we get inflation and all the services and all the contractors are going to charge more and all the prices at Home Depot and Lowe's are going to cost more. So we're going to have higher expenses with the properties, higher cost to fix things, plus higher property taxes, plus higher home insurance, and therefore rents are going to get even higher for people that can't even afford it in the first place. I also fear if we keep getting an increase in housing prices, that it's going to cause an even worse consumer debt crisis than we're already in. And if that's the case, and banks are having a hard time giving loans out, they might change lending guidelines. We might start going back to the types of lending practices that we saw in 2008. Lenders may increase the debt-to-income ratio, allowing borrowers to have more debt on their house than what they bring in with income. Currently, lenders like to see about 30% of your income going towards housing. But if they start raising that up to 60%, because even FHA loans can allow up to almost 50%, if they start raising that up to 60% or more, we're going to see more and more credit card debt. People are going to be less able to afford fun stuff like vacations, going out to eat, spending money on their kids' sports activities. We all know how much that costs. And I think that this is going to be the beginning, or if we're already in it, of a really large wealth gap. And what I mean by this is you're going to have to pick a side. And I've been saying this for a few years. You're either going to be rich or you're going to be poor. There is going to be no more middle class. You have to pick a side. And you have to hurry and pick a side. This isn't something that's going to happen, in my opinion, in 30, 40, 50 years. This is happening now. We are seeing big changes now in our economy. And we need to decide what side of the aisle, what side of the coin are we going to be on. A lot of people's wealth comes from their equity in their home. And if housing prices continue to soar, we're going to have even more people's wealth in the equity of their homes. And if you are not a homeowner and you do not have equity, but you have high rent prices, you're going to be the ones in the lower category. It's going to be very hard, in my opinion, for tenants, for the majority of people that rent for life, to be wealthy. Because as rents go up, they're going to be spending much more money in housing. It's already ridiculously expensive. I'm from California and I have tons of friends and family, and most of my friends rent. Owners, at least, are going to get equity, even if they live paycheck to paycheck. Even if they put everything on a credit card and they have high consumer debt, so will renters, but at least the owners are going to have equity in their homes. And finally, what does this mean for our future if home prices continue to rise? That means our kids' kids are going to get less inheritance from their parents. The wealth gap is going to destroy it. Generational wealth may be over or greatly reduced because people are going to have to spend more money on their everyday living expenses and they will be saving less. Bottom line here is we have to pick what side of the coin we want to be on, wealthy or poor. I want you to be able to own real estate. If you don't already, this is your sign. Even if you live in an expensive area like California, you don't have to buy property near you. I have tons of students, probably 90% of them, live in high cost of living areas like California, and they buy out of state. They're buying properties that are worth anywhere from, $60,000 to $200,000, and they are building equity with those properties, and they are also cash flowing, so they're getting some extra money in their pocket today. If that's something you might be interested in, you'll need about $30,000 to $50,000 to start with a rental property because you're going to need down payment funds, closing costs, and some money for repairs. If you'd like to know how to get started with your first rental property, there's a link in the description below, and it's going to have some more details for you there. Now, in the beginning, I told you I'd give you 3 markets that cash flowed and appreciated, 3 of my favorite ones. So get your pen and paper out. But before I give it to you, please like the video, subscribe if you haven't already, and save this video so you can come back to this list and all the details that are in my description for a future time. All right, the first one up is Milwaukee, Wisconsin. The reason why I'm liking Milwaukee lately is because the single family rentals are in high demand. There's a lot of multifamily out there, which is great. A lot of people like multifamily, but single family rents for a premium because supply and demand. The second one is Cleveland, Ohio. There is tons of BRRRR opportunity there. That means buy, rehab, rent, refinance, and repeat. So if you're looking to recycle your down payment funds over and over again, you would be looking at the BRRRR strategy, and Cleveland is a great place to do that. The next one is Pittsburgh, Pennsylvania. What I've been finding lately with Pittsburgh is that you're able to find properties that are in good shape with tenants that are in there that pay on time, tenants you want to keep, so you're getting immediate cash flow from day one. I'd love to know, do you invest in any of these three markets? Tell me in the comments below what you think about them. And if you invest in different markets, I'd love to hear. And especially I'd love to hear if you invest in any smaller markets that are not a well-known major metro market. Tell me what they are below. I promise I won't tell anybody. Thank you so much for joining me today. If you got any value from this video, please like, subscribe, ring the bell, do all the things that helps me with the algorithm. It helps my ego, helps me say, yay, somebody liked my video, and it helps me want to make more content for you. Until next time, keep building your wealth brick by brick.